Welcome everyone to our third webinar of the M&A Advisory Series, Completeness of Tax Accruals. So before we get started, there are a few housekeeping items I want to make sure we go through. Just so you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll be able to see a questions box where you can type in your question and click submit. Our presenters will answer those questions as time allows during our presentation. Also, I want to make sure everyone has good audio quality, so please check your settings and ensure the appropriate options is selected. So if you're on your telephone, make sure you select phone call, and if you're listening through your computer, make sure you select the computer audio option. And then just as a reminder, we are on social media, so be sure to follow us on Facebook, Twitter, Instagram, and LinkedIn at armeninollp.com. And then just a little bit about our presenters today. So we have Kevin Wise, who's one of the executive leaders of Armenino's Transaction Advisory Service Group and advises clients on structuring of M&A transactions and tax due diligence. We have Christy Calderon with over 15 years of experience specializing in corporate tax provisions for multinational public and pre-IPO corporations. And we also have Dean Quiyambo, who after spending 12 years as an auditor in Armenino's audit department, Dean transitioned to be our chief relationship builder for the firm, and he helps numerous private, public, and nonprofit companies address their tax, audit, and outsourcing accounting needs. So take it away, guys.
All right, thank you very much. Thanks for having us today in our third webinar in our M&A series. The first one was on financial statement audits. The second one was on quality of earnings. And today we're talking about the completeness of tax accruals. So definitely looking forward to hearing Christy and Kevin share some of their insight. So why are we doing this? Obviously, some of these slides are through 2017, but the M&A market and the IPO market have definitely stayed strong through Q2 of 2018. And I think our last slide here shows some of that data. Even it's starting to creep back up. It was off to a slow start in Q1 of 2018. The valuations were strong though, and then if you look at where we are through Q2, it's definitely picking back up, and we're seeing a lot of activity in our client base, whether it's our clients acquiring more and more companies or our clients that are the target of large acquisitions. We're seeing it. And so today we want to talk about, how to be prepared from a tax basis and what are the big issues that you should be aware of. So some of the things that we'll be talking about today are, again, planning, specifically tax planning for that exit. We'll talk about some financial reporting, and then we'll dive deep into some common tax issues that arise during some kind of transaction. Is that
Absolutely.
Fair to say?
Yep.
Great.
Yep.
And those are the ones that we're going to specifically dive into today are transfer pricing, quality of NOLs or net operating losses. We'll talk about any state tax issues and R&D credits. So with that said, let's start going through some slides.
Okay, thank you, Dean. Like most important things in life, we have to plan. We might not always be good at it, but a little planning can go a long way. First thing we want to do is control the timing of the deal if we can. One of the most significant mistakes is, selling the company at the wrong time. So we want to prepare ahead of the exit. We want to re-examine our cost structure and streamline where necessary. We want to address known risk areas such as tax, if you have tax noncompliance, regulatory noncompliance, or contract noncompliance. You want to address those now before you get into discussions with a potential buyer. And so leading up to a transaction, you really want to address your risk areas and have them known before they're discovered, excuse me, during a due diligence process. All these things can help you enhance your cash flow at closing. And so obviously these are things and steps you want to take in leading up to a transaction. First of all, financial reporting. Due diligence is a number crunching exercise. So you need a strong financial team in place, because if you're the seller, obviously you want to have a smooth transaction and get to close as fast as possible. And one of the most important ways of accomplishing those goals is to have a good financial reporting systems in place and a good financial function. And it starts with a good financial reporting team. Obviously, it depends on the size of your organization in terms of the size of the team that you need. But leading up to a transaction, it's time to evaluate the team that you have in place and determine whether you need additional resources. Let's think about it from the buyer's perspective. The buyer, when you're purchasing a company, it's high risk. And so if a purchaser comes into a deal and they have insecurities about the quality of data they're getting from your current ERP system or your current team, that's going to really bog things down and expand the scope of financial and tax due diligence, particularly financial due diligence, and to the point where they may even want a quality of earnings type analysis, which is really, looking at revenue recognition and testing the quality of your earnings. And so having a strong financial function can mitigate these risk areas. And so starting with the team and adding resources to the extent you need, implement financial controls and processes. It sounds tedious, but it's important. Again, it's all about getting the buyer comfortable. And getting the buyer comfortable with, if you have strong internal controls and processes, they're more comfortable that errors or improprieties can be discovered in the system. And again, giving them greater comfort reduces due diligence. GAAP financials, if you have GAAP financials, then you're in great shape. But if you're a company that hasn't had an audit or even a need for GAAP financials, you may want to consider that. You don't necessarily need an audit, but you probably need assistance on converting your financials to GAAP financials. Again, it gets to the quality of information that we're going to provide to a potential buyer. The higher the quality, giving them information that they're familiar with, GAAP financials will go a long way. Tax matters and how they affect the financial statements, how they affect the completeness of your tax reserves and your tax accruals. This is another area that you have to re-examine leading up to an exit. Transfer pricing, many of you are familiar with it. It's just the pricing of goods and services between related parties. This is the number one contentious issue between taxpayers and the governments around the world by far. And so if it's that important to governments, it's going to be that important to a purchaser. So what we're talking about when it comes down to transfer pricing, if you're operating outside the United States or operating on a global basis, it really is talking about, we have a global profit. How do I split up that pie so that each respective country gets their appropriate level of taxation? So the purchaser is really concerned with two things. Number one, they're concerned with, has the right amount of tax been paid around the world? And if not, of course, that's going to bring forth risks to them, and which is going to come back onto the seller in terms of holdbacks or reduction in purchase price. The other thing they're concerned about is the economic ownership of intellectual property. Now, we're not talking about the legal ownership of patents and things like that. We're talking about who is actually exploiting the intellectual property, and that will drive who is the economic owner. Generally, from an acquisition point of view, you want that ownership to be centralized, usually in one or two places. So if you're a US-based multinational, typically the IP is here in the United States, and the foreign subsidiaries outside the United States really don't have rights to exploit that IP. If IP is owned by various parties in the group, then it becomes very difficult acquisition from the purchaser's point of view. And so, of course, if I would say in my experience, transfer pricing always comes up and is always a contentious issue, even if you have appropriate documentation in terms of your transfer pricing policies. It's really a valuation exercise, and value is sometimes different people can have different opinions on what the value of a service or product is. So it's an important area to focus on leading up to a transaction.
And Kevin, on transfer pricing, I mean, I know you said you started off with transactions between related parties. Just to confirm, is that only international transactions?
No, yeah, it's primarily international taxation, but actually can have it's between any related parties that are not members of the same, consolidated group, for example.
Okay.
So it can be between domestic parties, and it can have an effect for state income tax purposes as well.
Okay. That's good. So that study getting done, a big deal.
Second, quality of NOL, Section 382. So what we're talking about, that's an Internal Revenue Code section, and it has to do with the limitation on use of losses, net operating losses, following a change in control. So obviously, if an acquirer is coming in and buying the company and acquiring 100% of the company, that's going to be a change in ownership, and those NOLs are going to be subject to limitation. However, that's not exactly what they're concerned about. They're concerned about whether those NOLs are already subject to a limitation, and that when they buy it, it'd be subject to even a further limitation or have just less use for them. And so a lot of VC-backed companies, for example, go through a number of financing rounds. And because of those financing rounds, they can actually have a change in ownership, and they might not be aware of it. And so it's important to, leading up to a transaction, to get a section, what we call a 382 analysis or study, to test the quality of the net operating losses, to see if those losses are already subject to a limitation. And if they are, they're going to be less use potentially to a purchaser. And so, again, it's about preparation in the leading up to a transaction. And if you have an analysis that you can provide to a purchaser to say that the NOLs are of good quality and that they can make use of them, that's obviously a positive thing to put forth. And whether you have a limitation on the net operating loss is also going to affect your financial statements. If there's a limitation on the use of losses, you may not be able to book a complete deferred tax asset against for those net operating losses. Also, I want to talk about for purchasers, if they're buying a loss company.
Well, let me just pause real quick. So if you haven't had, say, a tax provision done or anything like that, say you don't get a financial statement audit and you don't have a tax provision done, so you don't have deferred tax assets or liabilities booked, that would be maybe a further reason to do something like a Section 382, right? To figure out all you know is you have losses. But you don't, and maybe you've taken rounds of financing.
Yeah.
You don't know what that loss is going to look like. If someone sees, oh, hey, they have losses and maybe they can write them off or, acquire those losses, it's not necessarily true.
No, that's absolutely correct. And so, I mean, you can expand it beyond Section 382. So if you're a company that hasn't had an audit and really a need to, determine your deferred tax assets and deferred tax liabilities, doing that leading up to a transaction in conjunction with GAAP financials and a Section 382 study could go a long way.
Great.
Also, with losses, if you do have losses and sufficient losses to offset any kind of gain on sale of assets, a purchaser greatly prefers to purchase assets. And the reason for that is really twofold. They can leave liabilities behind, so undisclosed or unrecorded liabilities they won't assume, so they can mitigate their risk. But the other important reason is that their purchase of your company or the assets can be amortized essentially over a 15-year period, in some cases less in the case of fixed assets. So the purchase price can be 100% deductible. So they prefer to buy assets. And so if your company has losses, it might be a great opportunity to get additional benefit to the purchaser and also push, from your point of view, push the purchase price a little bit higher because they're going to get a tax benefit from that purchase. So having losses, as long as the company obviously is in the right direction, growing, has cash flow, but has losses because it's building up market share, that's not necessarily a bad thing. And so quality of NOLs is an important thing to validate.
All right, so another area that often arises in the due diligence and M&A process is in the state tax arena. Companies must ensure that they have identified and addressed all filing requirements for state purposes. Generally, a filing requirement is brought about from having nexus within a jurisdiction. Nexus can be created by people or property within the jurisdiction, or by merely having sales other than tangible property in excess of a specified threshold in a jurisdiction. So some states have enacted these so-called economic nexus standards, whereby they've determined that a company can't have sales of other than tangible property, such as services or licenses, in excess of a certain dollar threshold and not have nexus within that state. Public Law 86-272 is still the law of the land with regards to tangible property, and so the economic nexus only applies to property and sales other than tangible property, so such as those services or licenses. Companies should also consider if they have nexus in foreign jurisdictions as well, to ensure that they've met all worldwide filing requirements in all jurisdictions. So often we think about nexus with regards to states, but it does apply to all foreign jurisdictions as well. As filing is always a management decision, there could be reasons that the company has chosen not to file in particular jurisdictions, even though they may have nexus there. If a company is not filing where there is a requirement, even if you have losses, you could have capital-based taxes or minimum taxes. So the company needs to make sure that they've set up a reserve to cover any of those taxes that could be assessed, as well as the penalties and interest that would come about with those taxes. And so make sure that that piece is accrued on the company's balance sheet. So the next point is to ensure that the proper state apportionment methodology is being used. And so states are often changing their apportionment rules, so make sure you're talking to your providers to ensure that they're considering whether the state is a cost of performance state or a market-based state, to determine how sales should be sourced, and also that they're throwing back any tangible property to the jurisdiction where it is shipped from. Another area is to ensure that the company has considered all necessary state adjustments in computing state taxable income. Given the Tax Cuts and Jobs Act of 2017, there are many new state adjustments coming through the state returns, as some states have adopted the new laws, some haven't, and some are still determining what they're going to do. The filing deadline for most states was yesterday, so a lot of states have addressed this, but there are provisions coming through that began in 2018 that the states have not yet addressed, and so stay tuned to see where the states end up on those. A couple of other gotchas. Yeah.
No, go ahead. I'll let you finish, and then I think I have a question.
All right. I was just going to say a couple of other gotchas to look out for are for the non-income taxes that often are not part of a income tax engagement, but the Washington B&O tax, Ohio CAT tax, Nevada commerce tax, the San Francisco gross receipts tax, and property taxes. These are often outside the scope of an income tax return engagement. All right, Dean, did you have a question?
Yeah, it just seems like, we're seeing more and more state tax issues popping up, especially with, changes in laws. Maybe you're, you're an e-commerce company, or you're in the cloud and you have clients, multiple locations. Can you maybe just touch on that a little bit with regards to, states wanting to claim more that way?
Yeah, definitely. I think what the states have seen is a lot of the rules are old, and so with the advancement of technology, there are a lot of new types of sales, and so that's why you kind of get into this old tangible property where people were selling widgets, and you sold however many widgets to your customers, and that's pretty easy to keep track of. But now you have online sales, you have intangible property that you're selling, such as services. We have a lot of service providers, a lot of SaaS companies, and a lot of revenue that's derived from royalties or licenses. And so keeping track of all that, especially when you have kind of these intangible services or licenses, like if you're selling music, where does that music go? Where should that be sourced? And so it's definitely, talk to your advisors and make sure that a lot of times state taxes are kind of overlooked or an afterthought, but make sure that you are addressing these issues because it can have a significant impact. And so especially once a company is profitable, you could be talking about a lot of money in taxes. And also, even if the company is not profitable, like I said, there are some of these gross receipts-based taxes where you could have taxes due simply based on the revenue of a company, not necessarily the income or net income, but purely on revenue. So.
Right, Christine. Also, sales tax obviously is a huge issue, particularly for SaaS and whether it's subject to sales tax or not. And so obviously that doesn't really matter whether you're a profitable company or not. And so that's also very important to take a look at. I find actually, companies can be a little bit loose or cavalier with state tax issues, particularly if you're loss making. But when you get into a transaction, I think they start to regret it. And so this is an area, again, with proper planning leading up to a transaction, we can address these state tax issues or sales tax issues in advance of a transaction, and it'll be greatly appreciated by a purchaser, again, just making for a smoother transaction.
Definitely. I think in the due diligence calls that I've been a part of in meetings, sales tax always comes up, and it's always, how are you sourcing the sales? Where do you have nexus? Are you filing everywhere? Do you have the certificates? And so it's definitely an area where doing a little planning up front and making sure you kind of have all your ducks in a row really goes a long way in that kind of final moments of due diligence and getting the deal through. All right, so the next topic is the R&D credits. And so the companies must ensure for the R&D credits that they have proper documentation in place to support the credits that have been claimed on the returns. So the IRS has imposed these contemporaneous documentation requirements related to the credits. And within those, you have to track the majority of the credit is derived from wages of individuals that are performing that R&D, and so you have to track it on a project-by-project basis to determine whether or not the wages are qualified R&D expenditures or not. And this data is something that is significantly easier to obtain in real time versus going back 3 or 4 years to obtain and try to support the credit claimed at the time. Because we do have a transient workforce and people consistently change companies and are performing R&D, a lot of engineers are moving throughout the marketplace. And so if you know, and companies are also working on a myriad of different projects at a time. So if you can do this in real time, it makes it a lot easier to talk to the people who are actually doing the R&D to determine what projects they are working on and to conduct these interviews with employees to make sure that you have the project-by-project documentation in place that's needed to support the credit. And so this can be a really high value to a buyer because it is a dollar-for-dollar benefit as a credit. And so this can be a large tax attribute that the company, the buyer, is very interested in. One thing to consider with this is that you do need to consider any potential reserves that need to be placed on the credits that have been taken or claimed on the returns. And so with that, this was a tier 1 issue with the IRS. So any company who claims an R&D credit on their return, as soon as you're audited, the IRS is going to ask for this documentation to support the credit. And almost always there is some portion of this credit that is disallowed by the IRS. And so if you have an R&D credit, expect to have a reserve against a portion of that credit. If you are a loss company, it's a deferred tax asset that you just reduce by the amount of the reserve. If you're using all of the credits, then you need to set up a payable reserve in case the IRS comes in. And so with that, I will, go ahead.
Yeah. So with similar to net operating losses, right, the R&D credit could be subject to limitation following a change in control. And so it's a similar exercise in terms of the quality of the R&D credits. And you mentioned contemporaneous documentation. That's not to say that if somebody believes they have research and development credits available to them, but they simply haven't documented them or calculated them correctly, it doesn't mean they can't go back and cure that situation. Is that correct? I mean, they should be able to go back and get a study firm up the quality of those research and development credits.
Definitely. So you can go back, and even if the return that was filed for that year did not have the R&D credit on it, you can still claim a carry forward of that credit if you would not have used that credit. And so you can go back a few years and get this information, but just the difficulty in getting the information, it becomes more and more difficult as time lapses.
Right. Agreed.
So, all right, I think with that, I will hand it back to Kevin and Dean to wrap up.
Okay, thank you. Yeah, so we talked about a few subjects that are typical in sort of the high-profile topics in a due diligence or getting prepared for an exit. It's all about, again, preparation, and identifying your risk areas and mitigating those risk areas to the extent you can, leading up to a transaction, and planning. Some other areas, because of the new tax law that was enacted at the end of last year, if you have international operations, there's going to be certain areas that a buyer is going to be, keen on. For example, this transition tax, where all offshore earnings were subject to tax. They're obviously going to be interested in seeing that calculation. Not high controversy, but everyone's interested in seeing that calculation. Again, it's all about maximizing your closing cash if you're the seller, and also mitigate your stress. I mean, we've had transactions where, yes, at the end of the day, it was a closed deal and they got the price that they wanted, but they got a little bloody in the process, and it wasn't very pleasant, and stress was very high. So planning can, if nothing else, mitigate your stress. Should enhance the purchase price and make for a quicker close.
Yeah, and Kevin, I would assume that, say you're a company that's out there, and you're saying, hey, we're doing really well, and we hope that one day, that is our exit, but you haven't had audits, you haven't had quality of earnings reports. I think that it would be a healthy exercise to say, hey, just take a look at my financials from a tax perspective, and look at where do my risk lie. Maybe they don't know where their risk lie based on their operations, but they say, hey, I know I have big operating losses. I file a return. I check that box, but they don't know where the risk lies with regards to valuation and due diligence.
Yeah, no, absolutely. I mean, for example, we had a client last year approach us, it was a profitable company. And the owner was a brilliant engineer, but he actually recognized, he's getting too close to an exit where he wanted to sell. But he rightly decided he wanted to professionalize the organization. And so he asked for our help in bringing in a CFO. We helped him source a CFO and a controller. He also hired a professional quality control person. And so he kind of professionalized the entire organization. The finance team upgraded their ERP and accounting package and so forth. And they took that year to do what we talked about, identify risk. And he's in the process right now of selling. And he told us that he was so happy just from his own personal stress,
right,
that he got prepared. And he took our advice. So
yeah, and we hear that over and over again is, go ahead and make that investment in the finance team, work with your partners to look at your numbers to say, hey, where am I going, and what do I need to do today to be prepared? So thank you very much.
Right. I mean, accountants are the answer to everything, Dean.
Spoken like a true tax professional. All right. And with that said, thank you so much, Kevin and Christy. We know that yesterday was October 15th, and you're here on October 16th doing a webinar with us. So thank you very much. And if you have any questions, please feel free to email them to us. Thank you for joining. Oh, and please remember that we have two more in the M&A series coming up, equity and valuation, on the dates above. See you then.